Imagine paying someone a fifth of your profits plus a flat management fee just to let them gamble your money.
Right. And historically, they still lose to a blindfolded monkey throwing darts at a stock ticker.
Exactly. It's wild. Well, welcome to today's deep dive. We've got a really great investment guide today, and our mission is to slice through all the financial jargon. We want to decode how index funds, mutual funds, hedge funds, and ETFs actually work under the hood.
Yeah, and a really good way to think about the foundation of all these funds is it's kind of like a birthday party.
A birthday party.
Yeah, so instead of one person buying the whole cake, the drinks, and the music, everyone chips in. A fund basically pools your money with others to buy assets so you don't have to, manage it all alone.
Okay, that makes a lot of sense. But the real divide comes down to who is actually managing that pool, right? Like the difference between index funds and mutual funds.
Exactly. So an index fund is totally passive. It just tracks a scoreboard like the S&P 500 or the NASDAQ Q. But a mutual fund relies on active managers who are, well, actively trying to beat the market.
And that brings up a massive difference in fees. I mean, index funds charge a tiny, 0.02% to maybe 0.20% expense ratio.
It's practically nothing.
Right. But then mutual funds charge 0.5% to 1.5% or even more, though both of them do have that weird quirk where they only trade once a day at market close.
Yeah, based on their net asset value, or NAV. You don't actually know the price you're getting until 4 p.m.
Which feels like a massive blind spot if the market is violently swinging in the middle of the day. But wait, let me push back for a second.
Sure.
If mutual fund managers are financial professionals, shouldn't paying that 1.5% fee be worth it? I mean, if they can beat a basic index.
You would think so, right?
Yeah.
But the reality check in our guide shows that active managers rarely beat the market consistently.
Wait, really? Not even the pros?
No, almost never over the long run. And it's exactly why Warren Buffett advocates so heavily for passive index funds. The fees just eat up way too much of your compounding returns over a 20-year horizon.
Wow. Okay, so what about speed and risk? Let's pivot to hedge funds for a second, because I've always found the name incredibly ironic.
How so?
Well, a hedge implies safety, right? Like a protective fence around your money. But aren't these actually the most aggressive funds out there?
Or absolutely. They use highly risky tactics. We're talking short selling, massive leverage. They are essentially engineering risk.
And they run on that notorious 2 and 20 model, right?
Right.
A 2% management fee and a 20% cut of the profits.
Exactly. Which is why they're strictly legally restricted to high net worth individuals. Average retail investors can't just jump in.
Okay, so if hedge funds are out for the average person and mutual funds are too expensive, where do ETFs fit into all this?
So ETFs, or exchange-traded funds, kind of give you the best of both worlds. You get the low fees of an index fund, usually like 0.03% to 0.75%.
Nice.
But they trade all day long, just like individual stocks.
Yeah.
You get that real-time flexibility without losing the broad diversification.
So you're not stuck waiting until 4 p.m. to see what price you got.
Right, exactly.
Okay, so for you, the listener, the takeaway from this guide is pretty stark. For most everyday, long-term investors, low-cost index funds and ETFs are simply the most practical and historically reliable choices.
Yeah, the math overwhelmingly favors passive efficiency over active control.
It really does.
But, that does leave us with a really fascinating paradox to think about.
Oh, what's that?
Well, if everyone eventually realizes the math is better and abandons individual stock picking to just blindly buy passive index funds, who is actually left in the market to determine the fair price of the underlying companies,